All right, what I'm trying to do this evening is both introduce to this group the methodology that I've been working on for more than 40 years now. I call it a number of things, but usually I call it computational semantics. And it would be more than one evening's work to cover exactly what the methodology is about, but I want to apply it to the question of macroeconomic analysis, and specifically analysis of actions of the US Federal Reserve over the last 10 years. And that means that I'm going to have to go very quickly through how the methodology works in order to move ahead and show the application of it, which is the subject of tonight's talk. But for those who might be interested in delving more deeply into computational semantics and the implications of computational semantics, I will be, during the next month or so, starting a podcast series in which I cover not only how the methodology is structured, but apply it in a number of different fields: law, accounting, genomics, economics, which I hope bolsters my contention that anytime we have a text and we want to talk about how that text can be interpreted in a provably correct way, that is, instead of arguing about what's fake news and what's not fake news, we can actually demonstrate how the text can be understood semantically. I will send the attendees on this on tonight's presentation the links to the early podcasts when they're ready, and those of you who are interested in the methodology can take a look at that. Ibrahima, you're walking away. I need you to give me the next slide.
Yeah, I'm grabbing a pen.
Right. Okay. Thank you. Okay, semantic understanding, the computational semantic method. It is in fact the converse of the case method, which means that it is also the converse of what we understand to be modeling, semantic modeling or analytical modeling, and the converse of what is presently being described as AI. The case method was invented by Christopher Columbus Langdell in 1870. He founded the Harvard Law School in order to teach it. From my own point of view as a Darwinian, it's one of the great intellectual disasters of the last 150 years. Essentially, the case method says that it is possible to select in the law a group of decided cases, and from that group of decided cases, abstract through inductive logic, something which has been suspect since the time of Aristotle, but in any case, to abstract through inductive logic a series of principles which, as a body, those cases seem to support as foundational or deciding principles for the issues at hand. And then from those abstracted principles, one can then move on to new cases, new sets of facts, and resolve them on the basis of the principles extracted from the original selection of cases. For those who are familiar with machine learning and how what we're now calling artificial intelligence works, this is exactly the same method. The training set, a body of data from which the artificial intelligence software is supposed to draw general principles, general categories or classifications. A training set is selected. The software is trained on that initial set of data. From that initial set of data, the software comes up through what is as close as a machine can come, inductive logic, to a group of categories, a selection of classifications, usually 4, 5, or 6. And what has happened under the covers is that the neural network has come up with its own neural connections so that all new data can be sorted on the basis of goodness of fit into the 4 or 5 or 6 categories or classifications which were initially determined from the training set. And of course, analytical modeling works the same way. The model is built from an initial set of data which seems to embody principles. The model is built to conclude or to classify the data, to conclude that the data fits into those principles based upon essentially statistical experience with training data. And the fact that most macroeconomic analysis is done with models leads me to not only to be suspicious of most macroeconomic analysis, but to say that we should rip this right down to the ground and we should start again by re-examining our assumptions. And I think we'll find ourselves looking at a very different landscape in our macroeconomic analysis when we start with different assumptions and different measurements. Could I have the next slide, please, Ibrahima? All right. What we are trying to do with semantic understanding is recognize emergent properties rather than match patterns and do classification. It should be self-evident that with AI, with analytical modeling, with the case method, the one thing you can't find are the emergent properties. But as a Darwinian, I would say that the emergent properties are not only the most important thing that your experimental examination should discover, but they're the only thing worth discovering. But the fact that having been trained on the original set of data, your model cannot do anything with novel data except classify it into the pre-existing categories. The very thing you're going to miss are the emergent properties, the properties which are essentially outcomes of process which you have never seen before. And what we do in semantic understanding is precisely the converse of the modeling or the artificial intelligence process. When we find an output, an outcome of a process, which is in any way different from the outcomes we have previously seen from that process, we do not force it into one of the pre-existing categories. We create a new category. We expand our typological system. We create not just a new type, but all of the methods, the functions and procedures which are necessary to handle an entirely new type. So that instead of expanding the number of hits in each of the 4 or 5 classifications as we add more and more novel data to, we process more and more novel data with the model, in semantic understanding, novel data tends to increase the number of categories, the number of classes into which the data can be sorted, but more importantly, it increases our understanding of what the emergent properties are and what the etiology of those properties is. In other words, we are enabling an etiological rather than an ontological analysis. In all of the analytical modeling I know of presently in use, the ultimate process is to match, the analytical process is to match on an ontological basis, that is, as a noun, a novel data point to some previously existing archetype. It's an ontological match. It's a match of a noun. It's a match against a set of properties which was determined ab initio. What we're doing in semantic understanding is an etiological process. That is, we say, where did this new outcome, where did this emergent property come from? Because its identity is not the ontological specification or schema which it matches. Its identity is the chain of provenance, the series of functional processes by which it was created. This is very much a new way of looking at things. The best example of the application of this method that I know of is Professor E.J. Corey, professor of chemistry at Harvard, who won the 1990 Nobel Prize in Chemistry for his 1988 book called The Logic of Chemical Synthesis, where he effectively restated all of organic chemistry etiologically rather than ontologically. That is, the identity of this protein is not determined by its ontological conformance, its match as a noun to a pre-existing schema or specification. The identity of this protein is determined by the path of its synthesis, by the sequence of processes, by the provenance of how it came to be. And in semantic understanding, I am attempting to extend that methodology to any sort of analysis where there is a sequence of processes where input nouns are consumed by verbal processes, producing a new set of output nouns, which are themselves consumed by downstream processes, and so on. And next slide, please. Okay, so we are documenting the etiological provenance rather than the ontological classification of every object of our analysis. Next slide, please. Okay, now I have to start with some idiosyncratic premises when I apply this methodology to macro and economic analysis. First, we have to dispense with the current ontological definitions. They are in fact bogus, if not fraudulent. That is something we can see examining them directly without having to go so far as to change our methodology, as I would have us change it so that we're looking for etiological rather than ontological definitions. But in current um, macroeconomic analysis, we can pretty well dispense with most of the ontological definitions. They have been perverted to the point of being useless or worse. I'll give a couple of examples. We hear a great deal of talk about inflation, and inflation is supposed to be a uh, a key element in our macroeconomic analysis. But of course, the vast majority of uses of the term inflation mean price inflation. Um, Price inflation is not inflation. And I can say that with confidence um, because of the etiological process we engage in. That is, price inflation is a consequence. It's an effect. It's an output of a process. And the process of which it is an output is monetary inflation, the increase in the money supply. The same is true of wage inflation, which is occasionally used as a measure of inflation in the economy. But of course, these are nouns, and these are nouns which are themselves effects of pre-existing or previously executed processes, previously executed verbs. So given the assumptions of our methodology, we're going to begin by saying that what is called inflation, um, price inflation in most cases, is not what inflation actually means in an etiological understanding, an etiological definition of terms. And of course, we can look at what is actually used to measure price inflation in the economy, and we can see how in the last 20 years it has been manipulated. Manipulated is probably not sufficiently strong or pejorative a term. Uh, Once upon a time, the Consumer Price Index, the CPI, which is computed by the Bureau of Labor Statistics, was used as the canonical measure of price inflation. But then that measure was found to be too volatile, changing too much from quarter to quarter to work well with the standard models used by economists. So we got the PCI with food and energy subtracted out, those being the most volatile elements in times of price inflation. But of course, if you subtract out food and energy, you subtracted out the vast majority of what you're looking to measure in a unit of price inflation. The Fed now prefers what's called PCE, which is actually computed by the Bureau of Economic Analysis, who also compute the gross domestic product numbers. But again, PCE shows the same volatility in times of rising price inflation. So the number which is now used in the models which govern monetary policy is PCE with food and energy subtracted out, which again is essentially worthless because most of what you're looking to measure has been subtracted out of the object of measurement. We get around all those problems by saying we're not going to measure a noun, we're going to look at the verbs, we're going to look at the etiological process. The next slide, please. Okay, The etiological definitions need to be built from transactional provenance. That is, if we want to see what constitutes inflation, and if we are defining inflation as inflation of the money supply, which is the proper definition, because inflation of the money supply is a process, a verb, which gives rise to, as its outputs, as its consequences, price inflation, wage inflation, and other nouns which are measured. But in fact, what we should be measuring is the process of the expansion of the money supply, or in times of disinflation, the contraction of the money supply. The point being that as an etiological definition, it needs to be built on a transactional provenance. It needs to be built on a sequence of inputs consumed by a process, giving us outputs. Next slide, please. Okay, let's apply this to the specifics of the United States Federal Reserve's management of the money supply over the past 15 years. If we are looking for the emergent properties, we're going to be finding novel outputs of processes which should have been recognized as emergent properties, but which, because of the methodologies used, were classified, regardless of how attenuated their goodness of fit may have been, they were classified into pre-existing categories. And the first of these is the covered interest parity was lost. I will drop a link on this subject into the chat. But covered interest parity is a really interesting thing to look at. There was a BIS report, the Bank for International Settlements, the central banker's central bank, if you will, has a 2016 report, which I will put a link in the chat for, raising the question of how covered interest parity could have been lost post 2009. The article starts by saying that covered interest parity was as close to a physical law as anyone had ever seen in economics. It was the very basis for the foreign exchange market, and yet after 2009, the pattern which had been so prominent as to be considered almost a physical law suddenly no longer obtained. And what is this pattern? Well, essentially, foreign exchange is priced on the differential of the interest rates that prevail in the economies of the two currencies being analyzed. And that was supposed to demonstrate essentially the inflationary relationship or of the two currencies. It was considered the bedrock by which foreign exchange could be reliably modeled and tied to a reliably calculable price. But again, after 2009, the covered interest parity, which had prevailed at least since Bretton Woods, was no longer evident in the data. Had the macroeconomic analysts been using my methodology, they would have said, aha, we have an emergent property here. We have been able uh, for 60 years to slot these data points from foreign exchange, from currency exchange into this particular classification, but now all of a sudden they don't fit very well into that classification. And instead of forcing them into a classification which existed from the original training set, we would create an entirely new classification. We would do a speciation in the Darwinian sense of the understanding of the data, because what we were modeling was in fact a speciation in the output data itself, where it had once appeared with a particular set of attributes on a regular and consistent basis. It now appears with a significant alteration in those attributes, which should be understood to be the emergence of a novel speciation rather than a variation on a pre-existing class. Next slide, please. All right, the second emergent property, which should have been recognized but was not, was the repo market crisis of 2019. The repo market is essentially where banks can find overnight liquidity. And that is essential to the banking function because at the end of the day, there are those banks which need cash, and there are those banks which have existing cash that they would like to lay off for overnight interest. But the liquidity of the market suddenly dried up in 2019. And the only solution that was available was for the Fed to directly inject liquidity into the repo market to provide the repo facility, which has been, which essentially created money, which the banks could then lend and borrow overnight among themselves. This was a novel occurrence, a novel data point, an emergent property, which should have been recognized as such, but wasn't. It was simply seen as the opportunity for the Fed to take an emergency measure without acting on the underlying causes, without even examining in an etiological way what those causes were, why there was a novel outcome where there had once been a consistent, smoothly functioning market that exhibited with each new day's data points a consistent pattern. When that pattern changed, the correct methodology would have been to use the computational semantics approach to say, we have now seen an emergent property. We need to understand the etiological process by which this property has appeared, and we need to build into the understanding of the process the verbs which have acted on previously known inputs to, in this case, produce new outputs. That was not done. The Fed simply injected liquidity, but we know that the reason for the repo market crisis was the Fed's attempt for a very short time in 2019, um, before the COVID panic changed everything. There was a very short time in 2019 when the Fed was engaged in quantitative tightening, when the Fed was letting assets roll off of its balance sheet, which is to say that it was selling those assets in the open market and retiring the money, the cash, the liquidity, which it received in return for those assets. The immediate consequence of that was to dry up liquidity in the repo market and make it necessary for the Fed to inject the liquidity directly. This should have been understood as a novel outcome for which novel processes needed to be worked out and understood, but it was not. Next slide, please. All right, March of 2023, the bank liquidity crisis, which led to the bank term funding program. The bank term funding program still exists. It'll exist until March of this year. That is to say, until March of this year, the banks will be able to apply for new bank term funding program liquidity, but they will be forced to repurchase within 1 year. So there will be no new utilization of the BTFP after March of this year, but any utilization between now and March can run for 1 year before the banks have to repurchase. It's the subject of much speculation whether the Fed will simply extend the program. For reasons that I will later discuss, it seems unlikely that they will need to, and they certainly don't want to extend the program. But what is the bank liquidity crisis? It led to the failure of Silicon Valley, Silvergate, and Signature banks in March of 2023. And essentially, it was a duration problem. It was a negative convexity problem for the banks. Banks have two risks in making loans. One is the interest rate risk, where they are the longer the loan, the longer they are subject to interest rates moving against the funding, against the income that they have secured in a loan. And they have a duration risk because they are dependent upon deposits which are short-term and volatile and can go anywhere if they are able to get a better return elsewhere. So the banks are matching short-term deposit funding against longer-term loan income. And as rates in the economy in general rise, they find themselves with what's called a convexity, in this case, a negative convexity, where they have to shorten the apparent duration or the average duration in order to be able to make a spread between their short-term funding and their longer-term loan returns. And ultimately, they have to do that by shorting the longer term treasury market. They have to go short a longer term uh, commitment uh, because in a short position, uh, they will be able to uh, capture a lower interest rate um, while at the same time reducing uh, the spread between the duration spread between their short-term funding and their longer-term interest income. There was no good way for the Fed to deal with this in the case of the three banks in particular, because they had an extremely volatile um, and rate sensitive deposit base. Uh, that deposit base was going to leave on a moment's notice. It was going to leave on a moment's notice for any better rate that it could get than it was getting for its deposits at those three banks. And the only way that the Fed could deal with this issue was to allow the banks to consider their federal treasuries, their treasury holdings, as good collateral and to realize it as good collateral at par. Um, that, of course, removes those treasuries from the effect of the market entirely. And it didn't manage to save the three banks that went under uh, in the bank run of March 2023, but it did save, at least on paper, every mid-sized bank, perhaps every bank in this country, except for the too big to fails, or the big four, which are in effect arms of the government, something we'll talk about in a moment. Um, but again, this should have been recognized as a fundamental problem in that it was a new data point, an emergent property. After more than a dozen years of effectively zero rates, the banks were necessarily going to be squeezed by the difference between rising rates in the market and their own longer term treasury holdings, their own longer term loans, which uh, put them in a duration risk that they simply had no tools to deal with. Again, instead of dealing with the problem structurally and indeed understanding the problem etiologically in the first place, the Fed simply created an emergency solution, which consisted of ignoring the market reality and saying that the bank's treasury holdings were to be valued at par. Next slide, please. Okay, the famous bear steepening. We have been, for the past year, in an inverted yield curve. Thank you. All right. In an inverted yield curve, the shorter term bonds, let's confine the conversation to treasuries. In the shorter term, you have the Fed's shortest possible term, which is the overnight rate. you have the Treasury's 3-month and other short-term bills. Um, and then you have uh, maturities which go out as far as the 30-year Treasury. In a normal yield curve, when the economy is performing well, the assumption is that the rates, the rate of return on the longer term treasuries will be higher than those on the shorter term, uh, because there's no reason to doubt that over the course of a 10-year bond or a 20-year or a 30-year, that there will be a consistent and compounding rate of return in the economy, which will justify a, uh, a higher rate of return on a longer maturity. Uh, However, in uh, times of uncertainty, the market will invert, the yield curve will invert, and the narrower term, the shorter duration, shorter maturity treasuries will carry a higher interest rate because, uh, as in the previous example of the bank liquidity crisis, the uh, the concerns of investors are how much can I get today, when today's rates are rising dramatically in the market. Um, and essentially 10-year, 20-year, 30-year considerations become secondary at best, as opposed to where's the best yield for right now. And that produces the so-called inverted yield curve, where the shorter maturity uh, debt instruments have a higher return than the longer maturity ones. Uh, that is considered to be an almost certain sign of impending recession. But again, this is an assumption in the model, which needs to be questioned, not only from re-examining the model on an etiological rather than an ontological basis, but from examining uh, emergent properties, novel data points, which should have led us to see that something unusual, something previously unseen was going on. And in July, August of last year, we saw that in terms of the yield curve. Now, when you have an inverted yield curve, that is, the higher rates are closer in maturity and the lower rates are further out. There are two ways that the curve can return to normal. That is, two ways in which it can steepen, steepening being going from the shorter maturities on the left-hand side to the longer maturities on the right-hand side. If you're in an inverted yield curve, that curve slopes downward to the right. In a normal curve, it should slope upward to the right. And there are two ways in which you can get back to sloping upward to the right. By far the more common way is a bull steepening, which is generally caused by the Fed tightening or by the early stages of a recession, in which case the near-term maturities, which are yielding more than the longer maturities, are suddenly yielding less and less and less as the Fed tightens rates in the near term. Remember that the only rate the Fed can actually affect directly is its own overnight rate, which is the shortest rate there is. But actions there are expected to percolate through the rest of the yield curve in the economy. So in a bull steepening, the prices of the near maturities will go up, which means their yields will go down. The left-hand side of the curve, which had been elevated in an inverted yield curve, will come down. So the curve will resume its more usual shape of going upward from left to right. However, there's another way in which the curve can steepen. It is rare, and it should be considered its own novel or emergent property because it can't be fit in with any other ontological explanation in the model. But it hasn't been treated that way. And in July, August last year, we saw the dreaded bear steepening. That is, when the curve begins to resume its normal shape, going with the right-hand side of the curve, the longer maturity side of the curve, the yields going up. That means that the price of the longer maturity bonds is going down because, of course, the inverse relationship between price and yield. So that instead of the curve returning to normal by the yields on the closer maturities going down, the curve returns to what looks like a more normal shape by the yields on the far end going up, which is to say the prices on the far ends going down. And this is a danger signal which should have been understood to be a model changer at the time. But of course, because the model is set up to classify novel data points into pre-existing categories rather than to recognize them as new categories which need to be etiologically defined, that was not done. And we're just about to see the consequences of that play out. Next slide, please. Okay, the last of the 5 emergent properties that I'm going to draw attention to just happened on Friday, which was the S&P 500 hit an all-time high. And in the conventional understanding of the model, this is classified as economic good news. I would suggest that properly understood within its context, that is within its etiological context, as a function that transforms one set of inputs into a set of outputs. This was a novel event which should be recognized as fatal to the model rather than good news for the economy. And while it's too soon to work out in full the etiological explanation, the etiological definition of what happened, rather than the simple ontological definition that the S&P 500 hit an all-time high. What seems to be happening here is that the entire market, or at least the entire market as measured by the S&P 500, which is a very considerable majority portion of the equity market, is in a bubble, is in an asset bubble, which is the direct result of too much credit. That is to say, um, too much money created by the Fed in the economy. And if that's what we're seeing, it's very much like the bear steepening. Um, just because the uh, right-hand side of the yield curve is going up does not necessarily mean things are returning to normal, because there are two ways that the right-hand side of the curve can go up relative to the left-hand side. Similarly, the S&P 500 at an all-time high um, does not mean that equity is uh, acting as a store of value and an engine of earnings and growth. It may simply mean that it's a convenient and transactionally frictionless, or uh, with little friction, uh, place to put uh, an overabundance of liquidity in the market. And if that's the case, the model's understanding of what we're seeing is not only uh, completely wrong-headed, but the implications for the economy are both novel and dire. Next slide, please. Okay. From these 5 novel data points, which I argue are emergent properties, I'm going to venture into constructing an etiology for how we got where we are in the economy today, um, which is very different from the explanation, the ontological explanation, which gives rise to a sort of pseudo-etiological narrative, I suppose, that the ordinary um, analysis gives us. But I would argue that the etiology of what we're seeing goes back to the mid-90s and the so-called Greenspan put. Alan Greenspan, the maestro, or he certainly would have been considered, or continued to be considered, the great maestro had he not stayed on a little too long in the job as Fed chairman. But in the mid-90s, he essentially redefined the role of the Fed as preventing uh, market, I won't even say disaster, market misbehavior, market unpleasant outcomes. And this was actually widely recognized at the time and came to be called the Greenspan put. The idea that the Fed would provide a floor underneath the equities market, such that the prices of equities would uh, continue to hold stable, and there would certainly not be a crash in the equities market, uh, because the Fed could simply provide the liquidity which would allow the market to continue to make new highs. This is before the days of Greenspan's irrational exuberance speech, but it's actually of a piece with that, because it's based on an understanding that the equities market, as reflected in, say, the S&P 500, is actually a measure of economic soundness, of economic growth, of production, which it is not. Next slide, please. All right, the Troubled Assets Relief Program. Because the banks were choked with toxic assets in 2008, the Fed had no choice uh, but to take those assets off of the balance sheets of the banks and put them on its own balance sheet. Um, the implication of that, which no one seems to say in so many words, is that there is no difference uh, in the legal entity of the Fed and the legal entities of the banks. If their balance sheets maintain a two-way um, passage back and forth. Um, and in fact, by all reasonable measures, it amounted to a not just a nationalization of the banks, um, but a delegation of the fundamental banking function of maintaining a proper balance sheet against which banking business can be conducted. That function moved from the banks to the Fed um, and has erased any meaningful distinction between the banks and the Fed. Uh, the banks might be considered now to be the the shop fronts of the Fed that take deposits and make loans, but those deposits are ultimately um, readily exchangeable between the balance sheets of the Fed and the banks, and those loans are funded by the Fed, so that the banks are simply servicing agencies, but that the true bank, the only true bank, is the Fed itself. Next slide. Okay, quantitative easing. Um, once this stuff was on the Fed's balance sheet, um, it became clear that what the Fed had actually done was monetize the toxic assets. Now, theoretically, the Fed is forbidden. Um, it is illegal for the Fed directly to monetize the debt. Um, but if debt is acquired by banks and then immediately transferred to the Fed in exchange for liquidity, um, liquidity in this case being newly printed money, uh, the Fed has achieved in a two-step, which is only a notional two-step, what it's forbidden to do in a one-step, which is to directly monetize the debt. This is hugely important because we have discovered that in the current political polarization, there is neither a politically possible path to cut spending, nor is there a politically possible path to raise taxes. And not only is the deficit growing at an unprecedented rate, it doubled last year from roughly 600 billion to 1.2 trillion. The underlying debt is growing at the same exponential rate. We have a hockey stick power law curve describing the growth of the national debt. Went from 33 trillion to 34 trillion in just the fourth quarter of last year. And we can see beyond any question how that will accelerate. How does the Fed, how does the Treasury, how does Congress prevent the interest on that debt? because none of it's going to be paid off. It's going to be rolled over at higher interest rates. And the ongoing deficit is also going to be um, covered with additional Treasury borrowing at market interest rates. So, in that scenario, how does the Fed prevent the interest line item in the budget from dwarfing all others? Um, it is now the single largest discretionary item for this quarter. Um, it has now passed defense as the largest single line item. Um, and by the end of the year, uh, by any reasonable prediction, it will be double um, the cost of defense as a line item of the federal budget. And the only way to deal with this is for the Treasury not to pay interest. And the only way the Treasury can avoid paying interest is if the Fed is the holder of the debt, because essentially the Treasury does not have to pay interest on debt held by the Fed. Um, Nominally, it pays the interest, and then the Fed simply credits that interest back to the Treasury. So again, it's a two-step notional deal to achieve the one-step outcome of no interest on the federal debt. And certainly by the beginning of the new fiscal year on October 1st, it will be necessary um, in order to pass any sort of budget in Congress, leaving aside the political dysfunction, um, the role of the debt ceiling, the role of the deficit cutters um, in attempting to constrain spending. Um, there will be no way to pass a budget, even if the political obstacles could be removed, um, without exempting the Treasury from effectively paying interest on its borrowings. And as a practical matter, and actually easily practical matter, the only way to do that is for the Fed to acquire that Treasury debt and carry it on its balance sheet. Quantitative easing at an exponentially increasing rate, if you will. Next slide. Sanctions. Now, the other thing that etiologically has happened is the whole sanctions regime. OFAC and the FATF have been at this for uh, 2 decades at this point. But what happened with the Russian central bank last year or in 2022 illustrates what the Treasury, what presumably the executive branch of government actually thinks, and what Congress is compelled to go along with, which is that there is no ownership of US dollars. The position that the Treasury took with the Russian central bank was that it did not have to get physical access to US dollar reserves of the Russian central bank, the sovereign wealth of the Russian people. It could simply invalidate those particular dollars, which is to say that there had never actually been ownership, that there had never actually been alienation of those dollars from their creator to their supposed owner and holder. If the creator retained the ability to uncreate, um, to simply, as a book entry matter, um, uh, remove those dollars from existence. This is hugely important because it shows what the US dollar is going forward. Not only is it backed by borrowings, which being held by the Fed will pay no interest, uh, but it is not, in fact, the property of the holder. It is not, in fact, alienated from the creator. And therefore, the usual bundle of property rights clearly does not attach to it. Next slide. Okay. The implications. There is no legal distinction or boundary between the Fed's balance sheet and the balance sheet of the banks. If the Fed can move assets back and forth between its balance sheet and those of the banks, essentially at will, then there's no legal distinction between the banks and the Fed as entities. Next slide. There are no rights of ownership in US dollars if those dollars can be invalidated by their creator. If the creator does not, in fact, alienate in the sense of property rights, alienate the ownership of those dollars, which is clearly not the case with sanctioned dollars under the Treasury's current OFAC regime, then the US dollar is quite literally nothing but a book entry under the control of a self-interested player, not constrained by any rules for the benefit of the holders of those dollars. Next slide. There's no free market in US dollars or debt because of the implications of the Greenspan put. That is, the Fed cannot be punished, the Treasury cannot be punished by the shorting of their securities because those securities are simply notional values. And while those notional values may be traded, when the trade goes against the Fed, the notional values can be simply changed, mark to market, as in the bank term financing program. The Fed simply saw fit to market the Treasury holdings of the banks at par, thereby excluding any market influence from regulating the price, the value of those securities. And last slide. Okay, we're seeing the ongoing monetization of the debt, which, even if it has to be accomplished by the two-step of the Treasury sells the debt to the banks and the banks sell it to the Fed in return for liquidity, we've in fact got not just a way to sidestep the illegality of directly monetizing the debt, but a very convenient mechanism for doing it at increasing an exponential scale, which will, in my guess, lead us to a debt ballooning over the course of the next year from 34 trillion to something in excess of 60 trillion. But we'll see. Next slide. Yeah, there are no monetary limits on fiscal policy. That is, the political refusal to raise taxes has no consequences because the Fed has no way to put a monetary limit on that. The political impossibility to cut spending has no consequences because the Fed has no monetary capacity to limit that. In other words, the Fed has lost control of the money supply and has lost control to Congress. The Fed was founded in 1913 after the Panic of 1907, precisely to take the monetary policy out of the hands of Congress, out of the hands of politicians. It is now firmly back into the hands of politicians. They can continue to spend as they wish. They can continue to tax as little as they wish, with no consequences that can be enforced on them from monetary policy. The Fed simply has to enable the Treasury's issuance of debt to whatever extent is necessary to cover the fiscal mismatch of Congress, of politics, and then ultimately to take that debt onto its own balance sheet in order that the Treasury not be punished by paying ruinous interest rates for it. Next slide. Right. The erosion of principal through inflation is now meaningless in monetary terms. We first saw that with the covered interest rate suddenly changing a pattern that had endured for more than 60 years after the great financial crisis of 2008. It is now clear that there is no meaningful erosion of principal through the action of inflation because principal values are nominal, not just for the banks for whom the Fed decrees that treasuries can be marked to market at par, regardless of market realities. Next slide. Right, last slide. We have effectively got a CBDC. It's interesting that last week Donald Trump comes out and swears that he will never allow a CBDC, but in fact we have it. The banks are simply a servicing storefront for the Fed. The accounts of the individuals at banks are simply a pipeline or a portal into the Fed where the only true accounts are actually held. The only thing that a CBDC would do at this point would be to allow an actual devaluation to take place. And as long as the Fed is able to hold the majority of Treasury debt going forward, so that the Treasury does not pay interest on it, that only becomes necessary if you get a 1932 situation. And I'm not sure how you would get a 1932 situation because that was bank failures. And there are no banks to fail. There's just the Fed itself. But if somehow we got to the point where there had to be an actual devaluation rather than the ongoing de facto devaluation of the Fed marking the US dollar and dollar denominated debt on its own books to its own nominal preferences, then the CBDC could in fact be introduced. What no one seems to be talking about with the CBDC is that it's extremely unlikely that the conversion of existing dollars, cash, for Fed dollars, the conversion of existing bank account deposits for Fed dollars would be on a one-to-one basis. My best guess is it would be on a 20-to-1 or more basis. And just like March the 6th, 1933, Franklin Roosevelt was sworn in at noon on Saturday, March the 4th, and at 1 in the morning on Monday, March the 6th, he issued the executive order closing the banks. It could be done over a weekend by simply converting all of the bank deposits into new Fed CBDC ledger entries. And that conversion would not only not take place at 1-to-1, it would most likely take place at 20-to-1 or more and accomplish the devaluation, which would effectively erase the debt. All right, depressing as that may be, that's all I've got to say today. So,
Thank you very much, Dr. Perry. It's very interesting presentation. We're gonna take a couple of questions. Dr. Mari?
Yeah, fantastic. So I got about 3 questions, but I'm just going to ask one. It appears from what you were saying is that the hairy carry that the U.S. did to itself was the sanctions on Russia. Was that the message that you're trying to give, that if it wasn't for the sanctions, there'd still be options that the Fed could have taken?
no. I mean, that's simply the latest in the line of, if you will, de-propertizing the US dollar, taking away the property nature of the dollar. Once the Fed took the toxic assets onto its own balance sheet in 2009, it erased the legal distinction between itself and the banks, and it effectively demonstrated that the banks don't own anything. They hold things at the pleasure of the Fed, but only as an agent of the Fed. This takes that, the sanctions take that fundamental change a step further, in that other sovereigns, as well as individuals, have no property interest in US dollars, since those US dollars remain forever within the power of their creator to destroy. But there's no way out for other sovereigns. Everything is pegged to, underpinned by the US dollar. And there's quite literally no way to get out of that.
Okay, so it was the TARP program that was kind of like the initiating point.
Well, I went all the way back to the change in the covered interest rate,
Okay,
because that essentially that essentially delegitimizes currency exchange.
okay,
That if there is no mechanism for computing the relative values of currencies, then there is no relative values of currencies. Um, there is no autonomous relative value of currencies. It's whatever the Fed says at the moment.
okay. Well, appreciate the answer. I'll wait for others to chime in.
Any other questions or comments?
I have a question, if possible.
Yeah, go ahead.
Would you believe it would be possible for a bank that uses a Chicago plan method to survive in this type of banking environment?
No, there are no banks. I mean, the banks are simply servicing agents for the Fed at this. I mean, they're banking in the sense of taking deposits and making loans against those deposits is done only by the Fed. That is, the banks are servicing agents and they maintain the account records to show the book entry deposits account by account. They make the loans and do the loan servicing and maintain the records. But the actual liquidity and movements of liquidity are all done by the Fed at the Fed's pleasure.
Okay.
Okay, thank you.
Wayne?
Yes, many foreign countries keep a lot of U.S. dollars as on hand as part of their own so-called backing for their own currencies. What's likely to happen if we have the kind of default euro for the U.S. dollar that you're talking about?
Well, it's not a default. That's the point. That the artifice is kept in place that there are U.S. dollars backing those other sovereigns, but what those U.S. dollars mean is whatever the Fed says day by day that they mean, with the ultimate sanction being available that if they don't like those other sovereigns politically, those dollars can simply be invalidated with no recourse.
Okay. Alan?
How can those dollars be what did you say? Invalidated?
Same as it was done with the Russian central bank. The Russian central bank realized that reserves that it held in banks that would bow to the Fed, respond to the Fed, would be lost. But they never expected that US dollars that they held outside the reach of the Fed could simply be invalidated. But the Fed and the Treasury, OFAC, have taken the position that those dollars are dollars only to the extent that the Fed approves of their holder, how and where and by whom they're being held. And when the Fed ceases to approve, then the dollars are invalidated because they exist only as a book entry. I mean, the only way you can spend a US dollar is on the Fed wire. And you can't, I mean, you know, this was made perfectly obvious in a court when there was a case in the Eastern District before the pandemic, I believe, where there was a Lebanese national who had bribed an official in Africa using US dollars. He was arrested in transit through the US and was put on trial for that bribery. And the nexus as explained by the U.S. Department of Justice in that prosecution, was that all dollars settle at a computer in Brooklyn, and on the way to that computer in Brooklyn, they pass through a wire that goes right up the East River, so that the jurisdiction of the crime can be either in Manhattan, which is Southern District, or in Brooklyn, which is Eastern District, regardless that it took place in Africa between two non-citizens, non-residents of the US. The fact that the crime was conducted in US dollars means that the locus of the crime is the computer in Brooklyn, where all US dollars are settled by the Fed.
Interesting. I do have a question, Dr. Perry. So if you mention that the Fed basically is the principal and the banks are agents of the Fed, and the Fed still has that capacity to basically make foreign assets held in dollars vanish overnight. To me, that implies more control, not loss of control.
Yes, but it's not the Fed that's in control of the money supply, it's Congress.
Okay.
And that's just the point, that the Fed was founded in 1913 to take control of the money supply away from Congress, precisely so that it would not be politically motivated. But the Fed is now backed into a position where it simply has to respond to whatever Congress does, or more to the point, doesn't do, by creating enough dollars to purchase enough Treasury securities to finance the increasing deficits incurred by Congress.
Okay. So you are implying that we are now getting back to constitutional orthodoxy.
Well, money is supposed to be backed by something other than political favoritism. And you know, we'll see how this works out. I mean, it's very difficult to imagine how the Fed can be punished, because if the Treasury doesn't have to pay interest, then there's no consequence of inflation in terms of the Treasury. And there would have to be a worldwide repudiation of the dollar. And because of the dollar's role in effectively pricing every other currency in terms of Fed monetary policy, which was the point of the 5 data points I was isolating, then a repudiation of the US dollar would necessarily have to mean a repudiation of all fiat everywhere by everyone.
Thank you. Anthony?
Thank you, Dr. Perry. It appears that you're saying that the emergent properties of our current market are just summarising, the control of the printing machine has by chance fallen into the lap of the lunatics in the asylum. So those who used to control the printing machine are going to want to regain control. Casting ahead, how do you think that might happen?
Historically, it doesn't happen except by smashing the printing machine and going to hard money. I mean, one of the most clever things that the British did against the Continental Congress in 1778, 1779, was print far more continental dollars than the Continental Congress had authorized. And I mean, you know, the phrase worthless as a continental was strictly true. And the only way to tell the counterfeit continentals, the ones that had actually been produced by the Royal Mint, was that they were far higher quality than the real continentals. But that didn't make any difference when the money supply was quadrupled in the course of 9 months' time. The currency was destroyed. And there was not a sound currency from 1778, 79 until the assumption of the continental debts and the debts of the individual states by the federal government, which was the occasion of the Constitution. I mean, the way Hamilton got the assumption was by getting the Constitution, which took monetary policy completely out of the hands of the states and vested it in a constitutionally prescribed gold and silver specie regime. I don't know of any example where sound money has been restored without the complete repudiation of fiat first.
Marty, do you have?
Interesting. Thank you.
So you're not a fiat money fan, it sounds. Is that
Well,
oversimplified?
As long as you don't call it money.
So, my question is, in the case of a populist response, I see three options. One is to do nothing and just hope everything goes well. The second option would be to do something totally stupid, and the elites of the world would benefit from whatever that populist response would be. But I guess I'm asking you, what would be something a populist response would be that would be better than nothing?
It's very hard to know. I mean, if you look at the example of Napoleon and then its later echo in the example of Hitler, that's not very encouraging. I mean, you know, the revolution in France started because the entire budget for calendar 1789 had been spent before the end of February. And that meant that the political problem was, as new money comes into the treasury, who gets first call on it? As a matter of law, the entitlements of the aristocrats, they had sold to Louis XIV the right to administer their provinces centrally in return for guaranteed payments, entitlements in perpetuity. So as a matter of law, the aristocrats get paid first. But as a matter of politics, that's not going to fly. I mean, the indictment of the king, which formed the basis for the indictments of the aristocrats who followed him to the guillotine, was that he had stolen the wealth of the people, which was construed as treason. The only way that the French currency got back onto a sound footing was after 1799 with the conquests of Napoleon. You go and you take wealth from your neighbors. In a not dissimilar fashion, the collapse of the right of the mark in the Weimar Republic was only finally reversed through the conquests of Hitler. These are not encouraging examples.
Yeah, great. Thanks. Appreciate the honesty there.
Which assets did Hitler take? Polish coal and things like that, or what?
Well, yeah, the whole idea
Ruhr
was
Valley?
to exploit the labor,
Yeah.
exploit the resources. It's the Roman model of economy.
Yeah.
That you don't have a productive economy if you have you don't have a non-military productive economy if you have the legions to go out and take the treasure of your neighbors. At that point, all your economy has to produce is weapons.
Great. We're gonna take one more comment from question or comment from Anthony.
Thank you. I'm not sure whether you've studied complementary or parallel currencies, secondary currencies, but have you come across any particular role that a secondary currency might play out to help stabilize the economy if the primary currency collapses?
Well, you want it to work. You want it to be possible. The problem is that there's no closed. There's a closed U.S. dollar machine, and there's no obvious way to get away from it. That is, you can't escape it by going into any other fiat currency because they're all controlled by the Fed. You can't escape it into hard assets, gold, oil, crops, because you'll be sanctioned and will lose the ability to sell your assets in a market that's large enough to absorb them. You can certainly understand the motivation of Bitcoin and why in 2009 Satoshi wanted a non-censorable bearer instrument. But as time goes on, more and more of the infrastructure is not just censorable, but is censored. If you're going to go to a completely Bitcoin economy, you're going to have to do it without on-ramps and off-ramps. So how do the average people out there get into your economy? It's not at all clear. And because the on-ramps and off-ramps are all practicing KYC, AML, you're labeling forever those assets with the markers that the Treasury will be able to use to sanction. And they're already sanctioning Bitcoin addresses, that you can't do business with this Bitcoin address. And if you do, the rest of your business is criminalized. So until there's a big enough crack in the, at the moment, complete control of all monetary policy, it's very hard to know how you're going to be able to do any sort of commerce that isn't subject to the whims of this regime.
Certainly requires some more thought, doesn't it?
Yeah. You know, it's, again, I don't know what's going to get people angry enough. I mean, if the Fed gets itself in the position where the Treasury is not punished and Congress is not punished by inflation being reflected in interest on government debt, people may well go along with it for decades. Particularly when they're tossed bones like this utterly transparent asset bubble that says your holdings in S&P 500 stocks are now at an all-time high. Okay, great. How do you turn that into something that's not a dollar? How do you take those profits?
Thank you very much, and good night to you all.
Thank you.